and welcome panelists. Hi everyone on the audience as well. This topic actually, behavioral alpha, is of particular interest to a lot of us who are doing research in investment management. And when Aditya mentioned this, I was quite surprised, pleasantly so, that we are thinking along these lines now. For the last couple of years, I've been studying this specific area. And just to give a quick glance at what that really means, many of you would have come across the fabulous book called Thinking Fast and Slow by Daniel Kahneman and Amos Tversky, Nobel Prize winners, who essentially introduced the whole field of behavioral economics, and as a part of it, behavioral finance. And my most favorite example actually of behavioral biases amongst investors is the so-called certainty preference, where you say that would you much rather take 50% chance of getting 80 rupees or 100% chance of getting 50 rupees? And a lot of people will still go for the certainty, because although the expected value of the former alternative is higher, just that 20% chance that you get nothing makes a lot of people think that better off taking known thing, right? And many such other behavioral biases, which consistently affect investment performance, because people end up either doing the wrong thing at the wrong time, or just skipping doing a good thing at a good time, and so on and so forth. So in today's panel, we'll talk about how what is behavioral alpha and how can that be implemented by investment managers, investment advisors, and regular investors themselves as well. So let me kickstart with the definition question itself. So Nalin, since you've been in this alternate investment domain, I think I probably best pose this to you. How do you define behavioral alpha? What does it mean to you?
Swapnil, thank you. Great to be here. Hope everybody is doing safe and staying healthy. For me, the definition is very simple. It's just the difference between the fund return and the investor return. And that often comes because of different times of entry, exit, etc. So very simple, fund return minus investor return.
Got it. Oh, very helpful actually, and very precise as well. Prateek, would you want to add to that in terms of definition itself?
Firstly, thanks, Swapnil, and thank you for having me. I actually see it through a slightly different lens. So I see sort of, first let's talk about the investor. You have the investor who has his cognitive biases, which they have to control. Then you have the fund manager who has their own sort of cognitive biases that they need to control. Then you also have the advisor, who has to obviously, make sure that his investors, is sort of, on the right path of getting their goals and getting their dreams and futures, and make sure the investments are on path. In fact, what's strange is, most people see behavioral alpha as only something that can happen through stock picking or something a little bit more active, but actually it can happen through various means. In fact, just to give an example, a Vanguard actually, which is a 100% passive house, one of the most popular white papers actually is the one where they talk about behavioral alpha or the advisors alpha. And in fact, there's this company called Index Fund Advisors in San Francisco, which are hardcore fans of Vanguard, and they have 100% passive portfolios, and each of their funds are actually outperforming the index. So even so, it can come through different means and ways. So I do feel that it's very important. Coming to an AIF's sort of point of view, I do have limited experience in the AIF category, but the structure itself can really be useful, to manage behavioral alpha in a much better way. You have obviously, you do have, stuff like you can wind up the fund early, you can extend the fund a little bit later. You can have different pricing policies, and also obviously you can use a lot more flexibility in tools for you to manage behavior. You can use options for risk management. So I do feel that a combination of the structure, combination of the tools that you can use, apart from the investor, cognitive biases, can really add on to sort of behavioral alpha that I was talking about.
A very interesting example that you took there, the index fund advisors. A couple of my friends had sent me their way saying, talk to them before you propose anything to us in terms of alpha generation. And they obviously believe that there is no alpha in the
it's actually run by a very cool guy called Mark Hebner. So
I see.
he's a good guy to follow.
I see. Interesting. Thanks for that. Ashish, you'd coming to the examples, you'd mentioned yesterday when we spoke that there are quite a few different ways in which a behavioral alpha expresses itself or comes across. One example Pratik gave as well was the advisor-led alpha, if you will, behavioral alpha. How do you see examples of behavioral alpha in investment context?
Actually, frankly speaking, the whole Daniel Kahneman book which you referred to, I must confess I haven't read it. Okay, I know it's I know it's recommended reading. I haven't read it, to be honest, but yeah, I can supplement from the fact that and I have not been a portfolio manager, which means that for 21 years I've only been meeting investors and advisors. So there are few things, which I don't know exactly what bias or where it actually falls in terms of classification. But there are a couple of things which I have come across quite unfailingly at very regular intervals, which is almost this childlike behavior, which is to seek liquidity exactly when it should not be sought for. So, like, I don't know the right word in English, but in Hindi you would call them diggaj. Really big investors, who are entrepreneurs, who own listed companies. Okay. And I've got calls on 23rd March 2020 saying that we feel the need to create liquidity now.
Right.
And my conversation was, don't do it today just because I'm telling you, let's do it next week. Okay. Because, it's like absolute middle of panic, like 12 p.m. on 23rd March 2020. Why is it that you would need to seek liquidity? So the answer is, I would just feel more comfortable. And I was like, you might feel comfortable temporarily, but trust me, you will regret it. Okay, so this, and I think, incidentally, I was working with Pratik last year exactly when this happened, and we manage open-ended funds and we managed, AIFs and stuff. And one of the things is that we have all these AIFs which are closed. I mean, generally we had closed-ended AIFs to make the structure determinate.
Right.
And even the AIF clients called us, but they could only express their anguish. They could do nothing about it. They couldn't seek the liquidity. I mean, they couldn't exercise the liquidity. But people who were in open-ended products, they made all kinds of wrong decisions, really, if you ask me. That is one. The second thing which I have seen is that, everybody quotes, for example, if you are on your Facebook and email and WhatsApp, everybody says that, somebody would have bought 10,000 bucks worth of Wipro in 1980. There's a lot of folklore which flies around. I think sometimes, in fact, I've always quoted that example as a sarcasm, really, because everybody very promptly forwards it to everybody else, but nobody seems to implement anything. Right? I mean, and it's a completely, frankly, for lack of any other word, it's a rubbish example, because in 1980, Wipro was making vegetable oil.
Yeah.
And everybody quotes these examples, and they are 40-year-old examples, and people don't have that type of time horizon also. So I think there's one bias, which is that people follow all kinds of data which is irrelevant data for decision making, and which they are not even going to actually practice. So it's good to quote things, but very difficult to really follow all of those things. And the last thing which I have seen, which is again, I don't know how to express, maybe Nalin or you guys, you are portfolio managers, so you will be able to deal with this, explain this much better. But, when I go for client meetings, when people are making money, they are willing to buy all pieces of data and they are willing to buy all your hypotheses. But the same Nalin, the same Swapnil, the same client, the same data, if the market is 30% down, they'll question all your hypotheses and they'll question all your data. So I've seen when people are making money, they act like they are the fund manager. And when they are losing money, they act like they are the auditor. So I don't know where does this exactly fall in terms of biases, but I think either people, they see the wrong data, or sometimes people act like they're arithmetically challenged. So I think that being objective, keeping mental balance, I think these are the really crucial things, according to me. And yeah, I agree with what Pratik mentioned, which is that, sometimes AIFs, how you structure the product can really matter a lot in terms of whether it will bring out the worst of emotional reactions or will you be able to temper it actually.
Understood. Well, it's very useful actually. And to your point, Kahneman later on wrote another book, which could also be interesting reading. It's called Noise, which talks about how decision making gets distorted because of sheer amount of excess data and information out there which is just not pertinent to the decision.
I found Richard Thaler. I found Thaler's book more interesting, which is on
Yeah, that's the same genre of behavioral.
bit lighter reading.
Yeah, it's true. True. Nalin, any examples of having used this in a sort of opportunistic context or sort of using it to make money at your end?
In terms of what specifically, Swapnil?
I meant the fact that you know that. So one way, we'll talk about that with Mehul subsequently, where you tell investors that this is a good way to avoid these biases, right? But then there is a large mass of investors out there who might be driven by these biases, who we can't reach as advisors or managers and so on. Now, one can do the other thing, which is to say, for the investors who are my investors, how can I get them more money by virtue of making sure that the biases that others are expressing create some patterns of behavior which I can, for want of a better word, use to my investors' benefits. Are there any obvious, simple examples of that?
So I'll just give you one very, very practical example, Swapnil.
Sure.
The AIF industry is obviously very new. It's only about 8-9 years old. And there are so many different funds, strategies, ideas that are mushrooming all over the place, not just in the listed space, but also in the unlisted space. One thing that has really helped us is defining a box that a fund or a strategy fits into. Because these boxes are very well defined on the mutual fund side. You know what is a large cap fund, you know what is a mid cap fund, you know what is a balanced fund, etc. But you don't have these boxes in the AIF side. So we've defined these boxes. And now when I talk to clients, I'm very clear upfront about when the fund will do well, when the fund will not do well, and who it is for and who it is not for. And I think this clarity has stopped 90% of problems that we have encountered with people. So, there's no math to this, but it's just common sense. Define a box, talk about when the fund will perform, when it won't perform, and who the customer segment is.
It's a very interesting thing you mentioned, because often enough there is a fluid line between the investment advisors and the fund managers. And my preferred mode of organizing the world is fund managers do what they're good at and are very precise about what that is. And advisors do what they're good at, which is to talk to clients and fit these into what clients need and what not. And so the more precise a fund manager is, the better it is for the advisors and the end clients to then say, okay, you're saying X, you will do X. And I want X or I don't want X, versus a black box where everything goes. So very useful thought there. Thanks, Nalin. Mehul, one question for you. If you're looking at reducing underperformance or improving outperformance using the fact that cognitive biases of investors, whether they are part of your fund or otherwise, using that to improve the long-only performance, if you will, right? The standard equity strategies performance. How would you think about that as from the investment management side, long-only investment management side?
Yeah, so thanks, Swapnil, for that question. And just carrying on from what Nalil was explaining, it's very important to be very clear to the investors that you're bringing into the fund as to what your inherent style is, right? So what typically happens is every manager has a typical style, right? So there will be growth biased fund managers, there will be very value seeking managers. You just have to be very clear as to what your style is, what are the kind of companies you look for, and being very transparent in that understanding with the investors that you're bringing in.
Right.
What tends to happen is these styles themselves go through long periods of outperformance and underperformance, right? So over the last decade or so, and there's enough written about it, about how high growth, high ROE sort of businesses have done really well in the market, and let's say the value side of the market has not done very well. But that's not always been the case, right? If you look back into history, typically value has done pretty well. So there can be long periods of underperformance just based on the style of the manager. And therefore, it is important to explain that to the investors when they're coming in. What we are doing And unfortunately, you know, most investors don't seem to understand this, especially let's say the smaller investors. They're still coming to terms with some of these factor biases. They'll come in after a factor or a style has performed really well, and a large part of UM comes just after that, and usually the cycle just turns after that, right? And they'll redeem also at the worst possible time after the style has underperformed for 3 or 4 years. So what we're trying to do is not have extreme biases in our portfolio. What we are trying to be is be more consistent with our alpha. So we don't want to be, let's say, 20% alpha in 1 year and, down to 10% the next year. I think more consistent delivery of performance will lead to better investor behavior, because then, they will not come rushing in at the worst possible time and redeeming at, again, the worst possible time. So we're trying to create a more balanced portfolio construction approach. And then all of this comes down to portfolio construction. You can buy the right companies, but just having the right mix of companies seems to matter a lot more in the long run also. So that's, just in terms of portfolio construction, how we're approaching it. What is also important is in the investment team itself, right? So the analyst team and the fund management team that's present, you need to be very, again, not have herd mentality, not have one style, one thought process. You need to bring out different aspects of the team, different backgrounds, hire people from different backgrounds, just to get different thought processes going. And it helps a lot. So what we've done, for example, is we have a Wednesday team meeting where the entire team, including all sector analysts, the entire portfolio management team, sits in one room. We spend, we've divided the day into 3 sections. So we have an analysis section where we discuss companies, new stock ideas. And again, all sector analysts also sitting there. So even though we're discussing a pharma company, the financials analyst is also sitting there giving his thoughts. It doesn't matter that he doesn't have domain knowledge there, but just giving his perspective on what he thinks about the stock pitch. That helps a lot, just bring out some lateral thinking. What we also do is do a lot of introspection. So we look back and see, what worked, what didn't work, what could we have done better in the past. And obviously there's a lot of learning. So we have a book club, for example, where actually I had presented on the Kahneman book. So there's a lot of learning process. So I think, all of this is just to reduce the biases that we have and deliver more consistent returns through time. And I think that's all we can do as, as a portfolio management team to help the investors.
Got it. Understood. It was very pertinent as well, because I've always felt like investors oscillate between these two risk on, risk off modes. When it's risk on, then anything goes, and they just chase yields like there is no tomorrow. And risk off when they might steer clear of even quasi sovereign debt, saying I just want government security and nothing else. So and that's the way of the world so far. And the closer investors become in the balanced approach, I guess the better it is for them also. Now, this specific topic of behavioral alpha in AIFs, right, that prompted me to think, is an AIF structure a necessity for behavioral alpha? And so in that context, Rajesh, my next question is to you, that does capturing behavioral alpha require shorting or leverage or leverage, which then obviously is much more feasible inside the AIF structure than a mutual fund or a PMS structure? Sure. What are your thoughts on that?
I hope you can hear me.
Yeah, we can. Please.
Okay, excellent. So, before I answer that specific question, I think this psychology of human misjudgment is all pervasive. From being an emotional wreck to evolution to a very rational human being. That's the journey that mankind is taking. But it manifests itself most starkly in the capital markets, right? So that's why we probably see it. One thing that I can tell you is the antidote to that, and that's what we try to build in our culture as an investment firm, is really to emphasize 2 things. One is independence of thought, right? Come to your own conclusions is what I encourage, our people to kind of use that as an antidote to this emotional wreck that manifests itself in capital markets. And the second is I always encourage, our team to think in terms of second derivative. As Ashish pointed out, let's say if, the markets are down very badly in March, the question to ask is, of course, there are all these problems with COVID, but is it there in the price? So thinking in terms of second derivative is really the antidote, apart from independence of thought, that you encourage in the culture. So the way I think the question that you have posed is, are AIFs designed better to generate alpha relative to, let us say, PMS and mutual funds. Of course, don't ask Babar if you need a haircut. I run an AIF. So, I think there are two things that really strike out for me when as an AIF fund manager, a long short equity fund manager. One is this, ability to navigate equity markets while reducing risk when markets kind of look, as if they can fall disproportionately and increasing risk. Now imagine if in February or March of last year, when the markets fell 35 or 40%, you were able to protect capital, in fact, make some money. That's a very, very large value add that you can make, as a fund. That's a huge alpha that you've already created. So this one ability to protect downside is an extremely important value add that a long short fund can bring to the table, right? And, as Warren Buffett says, principle, rule number one, don't lose money. Rule number two, never forget rule number one. So I think markets and investors tend to underemphasize this ability to protect capital and how much it contributes to making sure that you make an attractive return over the long term. Protecting downside is definitely one of them. The second is, the ability to short, as you pointed out. Now, if I am a fundamental fund manager, the ability to look for ideas on the short book actually enhances my canvas, right? And look at it this way. There is very, very, as Nalin pointed out, there are very, very few AIFs in the long short format in India, which means that there is virtually absence of competition in the domestic institutional market as far as shorts is concerned. Now, some people would argue this is one of the most disruptive times for businesses ever of humankind, which means business models are getting disrupted, right? Cost structures are getting disrupted. Delivery models are getting disrupted. It's a great time for you as an investor to identify companies in decline. Where is the newspaper business? Where is the radio business today? Look at how e-commerce is challenging retailers. Payment platforms are coming up, which may influence, banks. Look at electric vehicles. So this is such a disruptive environment that having the ability to short is an enhanced ability to generate alpha. So I think both those 2 points, the ability to navigate markets and protect capital as a process, by the way, not as, we don't navigate markets by our judgment, but also through a part of process, which makes it consistent. And the second one is the ability to short. I think certainly both add up to generating alpha as far as AIF is concerned.
Agreed there, because I guess I've been a barber too in a previous avatar, so I know that shorting does go a long way in generating alpha. Whereas a fundamental manager who doesn't like a stock, constrained by long only, will be forced to just say, I don't like it, I'll leave it out. A long short manager can actually say, I will short the stock, which Absolutely. I don't like. Yes. So that's very, very pertinent. Pratik, you spent a lot of time in the passive investing space, and I'm sure you've done a lot of research in the background, and the Vanguard example you gave was in a similar vein. And we see the global trend now that in September 2019, the actively managed AUM actually, the passively managed AUM in US crossed the actively managed AUM, indexing plus smart beta and so on. As this trend reaches India, do you think that the advent of smart beta, indexing, and other rule-based investing will change the texture of behavioral alpha or alpha in general, but more specifically behavioral alpha in the Indian context?
Yeah, sure. Coming to the data about the US markets in the last 10 years, when you said that this data actually only talks about the mutual fund industry. So in the mutual fund industry itself, you have seen that passively managed funds have outperformed the actively managed funds. But if you look at a lot of the active money that actually left the mutual fund industry and gone towards alternatives. So if you see the curve of alternatives in the US, it's actually exploded over the last 10-15 years. So a lot of investors are now looking at using alternatives as a platform, to get access to more flexible strategies. Whereas the mutual fund construct right now is a little bit difficult or getting difficult for a lot of investors or managers, especially in efficient markets like the US, to be the benchmark. So that's typically what has happened. But coming to smart beta strategies, what I think there's a 50-50 sort of an opinion on smart beta. I think a lot of investors, especially the sophisticated investors, if you look at performance over say 15-20 years, have seen that smart beta is actually not as smart as what people think. I think the initial I would say a perspective of smart beta is that it'll always outperform. But what we realize is that there are sort of, especially if you look at factor strategies, which are becoming extremely popular. There are, as Mehul pointed out, there are sort of time periods when certain factors outperform others and underperform others. So I think that it requires an element of market timing, which is why retail investors should probably not really meddle too much with factor indices and stick with something simple. But I do feel that rules-based investing is something where especially in the behavioral alpha, I mean, in context to our conversation today, it not minimizes, but actually eliminates a lot of these biases, at least from the fund management side. So I think a big issue when it comes to fund management, for what I've seen, is actually style drift. Style drift is, what was your strategy and philosophy, and what has become of it due to changing market conditions. And it's perfectly fine if you're doing it intentionally. So just to give an example, Warren Buffett used to be only a value investor, but then Charlie Munger came in and introduced him to Coke and all these growth stocks. So now he's sort of a combination. Now he's going to tech stocks as well. So I think it's perfectly fine to change your strategy, but it has to be intentional. But a big problem, as I said, when it comes to the sort of traditional ways, is this style drift, which is unintentional, which causes problems over the long term. So I think that's where really rules-based strategy really comes in, and investors who are able to understand it, or who are able to understand or see it from a 3 to 5 year perspective, can really benefit from them in a big way.
Got it. Understood. Super. So Ashish, one question for you on the context of how real life investors, what behavioral changes, simple ones, right? Because the list of actual cognitive biases is so long that it'll take us like next 20 years to try and correct each one of them, including ourselves, right? But which would be some 2-3 big examples you think this will get like the 70-80% of the benefit, hopefully, of more disciplined investing for better behavioral alpha? Having seen so many investors now over so many years, what are those 2-3 things that you can leave them with? Like, do these three things.
Yeah, see, I just wish that investors made some notes of their own experiences and their own behaviors. A couple of minutes back, we were talking about behaving on extremes. In fact, there was a point in time in a meeting I actually told one of the investors that, sometimes when I meet you, you want to invest in state bank deposit, and sometimes when I meet you, you want to straight away buy Unitech. I mean, there is a world in between, right? So
yeah,
I think if people are able to make notes of how they reacted at different occasions through different parts of their journey and revisit that. So, look, because what can we say about ourselves as professionals? The fact is that investors' belief in us itself goes through cycles, right? So I think we can't be really teaching or preaching, but and behavioral biases, somebody else can't really drill it into you to behave differently. Even Rajesh mentioned that this is about evolution. It's like a big thing. It's much deeper. So I feel that if people made notes about how they reacted to different situations at different points in time and revisited those, I think clearly it would be a big achievement for them at a individual level itself. I think that is one thing which would be amazing. Going further, I think that we all have a big role to play, in terms of if you see the mutual fund industry, or like Rajesh described about long short, I think how we construct products, I think that is the big thing. Even Mehul mentioned, and I have personally seen it also, that when you have a particular style, the style can go in and out of favor, needless to say, and your outperformances and underperformance can get exaggerated. So how do you ensure that you are in a slightly narrower band? I think this is something like, according to me, for example, if there was a product in India which gave 9% return with lowest possible volatility, I think eventually that would be a hands down winner. That's my personal thought process. That's how I think. I mean, because what happens is when you go and show literature, everybody gets enticed with 20%. And other problem is CAGR किसी को समझ में नहीं आता, because you tell somebody 20% CAGR, he thinks it is 20, 20, 20, 20, 20. People don't understand that 20% CAGR is plus 60 and minus 20 and then plus 2 and then 0 and some such crazy bunch of numbers. CAGR समझ में नहीं आता है. So then what's the choice? The choice is that if people can, really work hard, and I think some of these long short funds or what the mutual fund industry tries with multi-asset funds, anything which narrows the range of outcomes, I think that's helpful, I guess.
Got it. No, it's very useful because a lot of innovation has been happening on this front about combining multiple relatively uncorrelated streams of cash flows or assets and so on. So that's my question to both Mehul and Nalin. As money managers or as fund managers, do you prefer a fund of funds approach where each fund is a separate unit which has a strategy and a separate fund manager and so on, and then there's a fund of fund which then tries to take it to an investor or an advisor to take to investors in turn, or a multi-strategy single fund, which then has maybe a single team which does different individual strategies. I understand it's not a either or, but what's your preferences? Mehul, if you can start with you and then go to Nalin.
Yeah, I guess again, probably a biased answer from my end, but I would say, if you had to invest in a long only equity product, you probably want to choose one manager who's managing, based on, as long as you're comfortable with his style and process,
Right.
you want to choose him to invest with. I think a fund of funds probably works better in terms of asset allocation across different asset classes. So between fixed income, equities, currencies, whatever else there is. But I think in equities only, maybe in passive products, you can, create these, multi-factor type strategies, etc. But as a pure active equity fund manager, I would say, we are trying to do the diversification already, right? I mean, like I mentioned earlier, we're trying to balance our approach between, let's say, growth, secular growth sort of businesses, some value orientation, some defensive. So we are already constructing a diversified portfolio and trying to reduce some of these factor risks and style biases that are there to increase our, returns through just bottom-up stock selection. So I think we're already doing that. I mean, that's what I would say as a fund house.
Got it.
I guess.
Sorry. Thanks.
Swapnil, my thinking is very clear on this. In the mutual fund space, please understand that today, even on equities, there is a 10% long-term capital gains tax. Okay. So rebalancing is not free for investors. And hence, the role of balanced advantage funds, multi-asset funds is very, very important in the mutual fund context. Right. And Naren and ICICI have demonstrated that with the balanced advantage category. Mm-hmm. And there is an opportunity to do very thoughtful stuff, which Prateek has started on the multi-asset front. True. In contrast, when you come to the alternative space, AIF and PMS, you're investing for a specific alpha, for a specialist, for the best-in-class manager. You don't want to diversify. You don't want multi-strat kind of things there. So pick horses for courses. And I think the thinking is very, very clear on this front.
Got it. It's in similar lines to what you mentioned earlier, which is avoiding boxing it, right? If you're boxing it, then it's single strategy as much as possible. Is that right? Great. Super. So thanks everyone for the insightful answers. I'll open this to a Q&A as Aditya mentioned, and I think Mehul, you had a meeting to switch to. So
yeah, thanks a lot, Swapnil.
Thanks, Mehul. Please carry. Aditya, we are ready for Q&A if there are any questions.
Sure, Swapnil, just a sec. So audience, if you have any questions, please quickly use the Ask a Question tab on your screens. Let's just wait for a minute or two. Let's see.
Sure. So just to summarize for the audience benefit, we talked about the definition of the term at the beginning. We looked at some examples of behavioral alpha. We looked at how behavioral alpha applies in a long-only context, in a potentially long-short context. In what sense will it get affected by the rise of smart beta or indexing and so on? And we also went through a little bit of investor side understanding of how investor behavior itself can create biases which have, I guess, the negative of alpha, which is loss due to cognitive biases. And we spoke about how they can improve their own investing styles, talked about fund managers being multi versus single strategy focused. And yeah, I guess that's the long and short of today's overall session. Aditya, you will tell us if there are questions.
I'm just waiting. So we don't have any as of now. So I believe you guys have already given them a lot to chew on. So maybe we can just wind up the session.
Certainly.
Of course, all the speakers are available on LinkedIn, and I'm assuming Twitter as well. So any audience, any of you want to reach out to them, feel free. They'll be more than happy to take your queries there, or help you with any kind of insights that you're looking for. So I'll just make a last try to see if there are any questions. No, so I think let's wind up.
Great. So thanks, Nalin, thanks, Ashish, thanks, Prateek, thanks, Rajesh, and thanks, Aditya and team for getting us on this panel.
Thank you.
Pleasure. Thank you, everyone.
Thank you, everybody. Thank you.
Have a good day. Bye.
Bye, guys.